Howdy, and welcome to the very first edition of the Bluegrass Broadcast. I'm your host, Kyle Gabhart, and I'm partnered here with Tyler Wright.
Howdy, folks.
This is an awesome production setup and a slight upgrade from what we dealt with previously. So you've been on 3 years. What have our previous conference calls been like?
Oh my gosh, we saw, the setup sitting in our conference room, which was pretty cool, but we've been as low as just on a Zoom call, sitting at our computers with our headphones
With like
on.
a fake background?
Yeah, the virtual background. This is real.
It's true.
But man, quite an upgrade. It doesn't even compare.
What's most pressing for folks right now as we've been talking with clients? What are we hearing so many concerns about?
Oh my gosh. Well, fear seems to be just a running trend at the beginning of this year. I mean, you look at the stock market and you can see that playing out in real time. People are starting to worry more about big tech and AI and whether or not the valuations make sense.
Sure. Yeah, no, there's no doubt about that. All the prices are going up, it seems. And the thing that so much of the economy is depending on is the technology industry, is AI. I mean, goodness, the last couple of years, if you remove that from the equation, the growth looks pretty mild by contrast. So
Right.
There's a lot concentrated in that area. But we've got to find some place to start the conversation. And I as I think about anything in the realm of technology, you've got to buy it before you can actually have it. So what's going on with the dollar? Because it seems that it's had a wild ride as of late.
Oh my gosh. So where do we even start? I'm going to say 2025
Okay.
because we got a new administration
Yep.
and there was an expectation on, we're going to start cutting the budget. We're going to increase or decrease rather government spending and make sure that we're not in a deficit and we're not increasing this massive debt that the United States has, and we're going to get the dollar under control. But instead what's happened is almost a complete rollback of that promise. And now what we're seeing is more spending, and that has sent the dollar plummeting, which has been very interesting. And what that has done to assets, so whether that be stocks, whether that be gold, whether that be materials that you're buying with those dollars, the prices of everything have continued to increase. So what does that mean is everything around you is appreciating because the dollar is how we measure the performance of everything. So when the prices of everything are increasing, is that really that the performance of them are great, or is the dollar just getting weaker?
I want to know why we didn't put all client money into hamburgers, because ground beef has been unreal over the past year.
You say that, but I mean, it actually has been performing better than the stock market, yes.
And so that's just really the overall shift that we've made over the last couple of years, is broadening the client exposure, not specifically to ground beef, but more broadly to commodities, right? So it's a much larger component of what we invest in is now precious metals, is food, but it's not just ground beef. It's corn and it's soy and it's wheat and it's all of those elements. So there's just so many considerations. But you mentioned there about the changes happening with the dollar. There's been some enlightening news lately that has really shifted things.
Oh, yeah.
So what have we got coming down the pipeline for us in terms of a big change?
So what happened, it happened in January because this year started very similar to how last year ended. Things are just rising. You saw the price of silver soar. You saw the price of gold soar. And then all of a sudden, Donald Trump announced who he would like his new chairman of the Federal Reserve to be, and it was Kevin Warsh. Now, this is a guy, he was sitting on the chair back when the '08 crisis happened, and back when that occurred, they obviously funded the economy and provided stimulus so that people could start spending money again and we could get through that hard time. But after he ended his seat in 2011, he was very critical of the continued stimulus occurring in the economy. It was unnecessary. It made the prices of everything appreciate maybe further than they needed to, and provided, a little bit of hardship for some people who could have otherwise avoided it. And what this has done is changed the expectation of the dollar from getting weaker to getting stronger. And what that does is if the prices of everything are increasing because the assumption is the dollar's getting weaker, a stronger dollar makes the prices of everything come down. So that's what we've seen at the start of this year. in light of that news. You saw silver really plummet, you saw gold take a little bit of a decline, and you saw the stock market plummet as well. But of course, we've seen a little bit of a slingshot upwards since.
So obviously, we care about the dollar because that's mostly what we have in our pockets. And like you mentioned earlier, that's what so many of our assets are measured in terms of. But over the past year, that hasn't been the story, right? The story hasn't been what is the dollar doing? The story has been about shiny metal. Right.
Yeah.
So everything's been focused on, in terms of currency, less so dollars and more about what has gold done. And my goodness gracious, what has silver done? And I know there's a lot to unpack there, but in the past year, as well as year to date, get us caught up on what's happening in the precious metals market, because that has been such a key element for this economy.
Oh, for sure. And as much as we would like to say that this comes down to us as individual investors liking gold more than the dollar, the big impact has everything to do with foreign governments losing faith in the treasury and shifting those assets from treasury bills, treasury bonds, over into gold. So they are able to buy it at such substantial rates that the price is just boom, shot way up. And when demand increases at the rate that it has been, price goes with it.
Okay. So apart from, say, just speculators that want to track the price of the metal and want to use it purely as an investment vehicle, like, what are these metals actually used for? Where do they fit into the economy?
Yeah, so both of them, gold and silver, work as dollar replacements. So when you're measuring a weaker dollar, those are going to be great things that you can jump into. But then there's the actual use of them. So silver, platinum, copper, they all have a real function, especially in the AI world, the whole topic of this conversation. And as we need more AI and more data centers and more energy, we're going to need more of those materials to keep building those chips. So as that demand continues to soar, so are the prices of those goods.
All right, that makes sense. Now, year to date, it's been extremely volatile, though. What has that looked like, number one? And then number two, why is it happening?
Yeah, so silver, because of what we're seeing with the dollar and the assumption that the dollar is going to get stronger, you saw gold and silver see a massive pullback, while the other metals haven't experienced that, which is why diversification is so important. If there's a headline we could put anywhere, diversification is key, especially if you just want to throw all your eggs into one of those precious metals. I pray it wasn't silver if you have done that. But it's key in making sure that your portfolio is protected from those big swings and from those big headlines, because as much as we'd like to think we can time it better than the institutions, we cannot.
No, that makes sense. All right, so we've got the dollar component, which we're going to use for effectively everything. Then we've got the raw materials going into the chips. But then the third piece, of course, is that it requires a bit of electricity to run all of this. And so what impact has that had economically speaking?
So utilities, historically, this is the safer part of the S&P 500. Of all the sectors, this one performs the best compared to all of them during a time of a recession. And now, over the last few years, including last year, utilities has been one of the higher performing sectors, and it's because we have such a demand for energy to power these AI centers. I mean, we were just talking about how AI centers have this massive demand for energy.
Yeah, so, right, to put that in perspective, we're here right now. This studio is in Fort Worth, Texas. And a big piece of the data center expansion has been happening in Ohio. And it was a really interesting data point. The podcast you and I were listening to on the way here was sharing the fact that the electricity demand for one of those data centers, and there were like 130 that they've got in Ohio, one of these data centers, exact same electric consumption daily as the entire city of Fort Worth. And it was remarkable to me because it wasn't like a Texas-based podcast that we were listening to. It just happened to be the data point they used. So shout out to Fort Worth. We're awesome, and we evidently use a lot of electricity, or data centers use as much as we do, one of the two. But it was an interesting comparison point that one of those data centers on a daily basis using as much as peak demand in the city of Fort Worth. That's enormous.
Yeah. And the question then becomes, how are we going to meet that demand?
Sure.
And as much as we'd like to think that we can keep drilling, or as much as we'd like to think that we can just burn enough coal or put enough windmills up or make water move the way we need it to, or put enough solar panels across as many deserts as we can, we are starting to see that the right answer could be nuclear energy.
But that sounds terrifying, right? I mean, we're going to blow everything up in the process. This sounds like a really bad idea.
Right. And for the energy demand, if we rely on those not clean vehicles, we're going to destroy our ecosystems because the demand is just so high. And renewable energy, when it comes to efficiency, it's just not that efficient because you need, if you're going off a hydro, you need the currents to be moving the right direction. If you need the windmills, you need the wind to be blowing the right direction. You need the sun to be up and it not to be cloudy in order to maximize efficiency for solar. But then when it comes to nuclear, it is clean and it's 93% efficient in terms of when you're able to use it versus when you're not. In terms of renewable energy, it stands at the very tippy top in terms of efficiency.
Okay, but I've seen The Simpsons, and I'm pretty sure we get three-eyed fish, and I'm going to have, like, extra appendages growing out. So what's the story there? Like, why isn't this a terrifying proposition that we're going to need to ramp up nuclear power?
Well, we need to make sure that we monitor it, because is the risk zero? No. And I don't know. I like the idea of a third eye right in the middle of my forehead. I feel like it might look good. Camera people might disagree. But in terms of how do we execute it, the need we have to meet, and then there's, how do I put this? We need regulations, and we need to make sure that we don't have another bad situations like the ones in history. And as long as we're doing the maintenance, which is about on a biannual cycle, so every 2 years you have to come in and make sure that all of these different variables are under control, as long as we're keeping an eye on things and nobody's getting sloppy or lazy, there should not be a massive problem.
Okay, makes sense. So we've got all of this energy demand happening, then that ultimately is going to end up hitting the bottom line for consumers, right? So how does all of that kind of roll down to the impact on individuals?
Well, you're probably going to see an increase in your electric bill.
Oh, boy.
Demand means price goes up. We've said it a few times, and the demand is massive. So you're probably, if you're nearby a data center, you're going to see an increase in your electric bill. But what we're worried about the most is, how do we make money off of this?
Yep. That makes sense. And really, I mean, that pivots into the next topic anyway, which is we've addressed trends, right? We've been talking about everything from the dollar and what the Fed is potentially going to do to looking at then the various elements that we would acquire with those dollars, raw materials, and then ultimately the ability to power all of this. But at the end of the day, folks out there want to know what's in it for them. And so how does this impact individuals, and ultimately, what are we doing from an investment portfolio perspective in light of all this?
Yeah, so if we just look at this year alone, and we look at the dollar, and we look at this demand for data centers and energy, we want to know, how do we best protect people's investments, and how do we get as good a growth as we possibly can in a safe and diversified way? So this year, most people hear the word dividends and they don't think, but that's not going to get me that much growth. Year to date, dividend stocks, and this is just based off a ticker symbol HDV, year to date, it's up 12%. The S&P 500, however, which is the index people typically look to for equities and measuring its performance, is up a little over 1.5. Triple Q, this is the big tech focus, is actually down the lowest of, or sorry, it's up the least of each of those symbols I measured, which is about 0.2% year to date. A lot of these big Apple, Nvidia, Amazon, the main users of AI have seen a little bit of a pullback. So value has been a really good way to diversify away from the high volatility risk companies that we're used to investing in, especially over the last few years.
So that makes sense in terms of just broad diversification and where the opportunities are. But some of the things specifically you've talked about, like precious metals, what are we doing from an investment thesis perspective, and both in terms of 2025, but also more recently, what are some of the shifts we've made?
Yeah, so we've expanded our commodities exposure, just like you said. So most portfolios over the last 5 years, you'd normally see what, 5%
Sure.
commodities exposure, including gold.
Right.
And then last year, earlier in the year, we just looked at where inflation was at and made a decision as a firm. When inflation's high, commodities outperform the stock market.
And then expanding beyond gold, what have we done in terms of other precious metals recently?
So we've expanded even more so with the demand for the raw materials into just a broad-based precious metals ETF. And that's going to include copper, it's going to include your platinum, it's going to include even a little bit of silver exposure, and then obviously gold.
Okay, that makes sense. So naturally, anytime the conversation around precious metals comes up, then people immediately go, all right, so is it time for me to stockpile this physically in a safe or bury it in the backyard? And of course, we've always had concerns around that. There's a lot of reasons why you might not want to do that. What would you say to someone who sees all of the ramp up that's occurred in the precious metal space and decides that they need to physically hold it themselves?
Yeah, I've even had the people come up to me and ask, like, okay, why would I invest in gold in a portfolio rather than just go buy it at Costco? And to that I say, go sell it and see what happens. They're going to charge you on a commission when you buy it. They're going to charge you when you sell it. And how are you going to store it and protect it? So when you invest in it in your portfolio, all three of those things are not something you have to worry about. They manage all of the custody of it. It's locked in a vault, so you don't have to worry about it. And they've made it in such a way that the fee for doing so is so low that you're just getting the growth.
Sure.
So that's why we're very adamant about the fact, don't bear the risk of storing this yourself and then having to go find a person to buy it from you. Just invest in it through your investments, and it'll all work out just fine.
Yeah, I mean, you've got the risk of someone hitting you over the head and taking it, which is no fun, right? You've got, like you said, the cost of dealing with it and the hassle. But then there's just the factor of you need to be constantly reevaluating your portfolio mix, and you tweak it, right? So a great illustration is silver, which most of last year started off at like $30 an ounce.
Yeah.
And then it was like double that by around Christmas time. And then it had this meteoric rise to $100-something a share and then cratered, right?
Yeah.
So you've got all of that volatility going. When do you buy it? When do you sell it? And what happens if you realize, oh gosh, I need to reduce my position in silver because of how much it's gone up. I need to reduce it by 30%. Well, now what am I doing? Like counting out my coins, and I'm just going to go sell that portion that I need. And so the liquidity piece becomes a huge issue.
And ultimately, it's what you pay us to do is monitor these things because your time is valuable and you don't want to have to be looking at this constantly. That's why you have a team in your life who's making sure that your money's well managed, it's diversified, and it's got an overarching strategy that makes sense given the macro events that are happening.
So I'm glad you brought that up. It's probably a decent time for us to remind folks what that cadence looks like. Talk through for a moment, if you would, on an annual basis and also then broken up into the smaller iterations. What is it we do in terms of the cadence of evaluating that mix and making those adjustments on the client's behalf?
Yeah, great question. So every single quarter, we're having conversations with CFAs from various financial firms. So that could be Harbor Capital, that could be BlackRock, American Funds, First Eagle, Prudential. We're having sit downs with them. It's not like we're shooting an email over to these guys. We get them face to face and we get to ask them, what are you seeing as something that's being bought more of? Or where's the demand when it comes to equities? Which sectors are people flocking over to? where are bonds at? What are going to happen, or what's going to happen with interest rates in the future? And we get to take all of these opinions, figure where the similarities are, or figure out where the similarities are, and then align our portfolios to match the themes that we're seeing with each conversation. So we have those meetings, those discussions, and then there's implementation time, which also happens quarterly. So we'll make the appropriate changes to the portfolios at that same quarterly cadence, and then execute and then rebalance monthly. So when folks are checking out their investments to see what's going on, if you're seeing activity occur, that's either going to occur monthly or quarterly. Monthly is just a rebalance, making sure you're not out of alignment with this percentage here, this percentage there, because your investments change on a day-to-day basis. And then the strategy is going to shift quarterly.
Okay, but what happens when something substantial occurs, right? Like in 2022 when Putin invaded the Ukraine, or this past April when Trump announced Liberation Day, and then there's blood in the streets and huge shifts in the marketplace, but we've already done our quarterly trade. Do we just sit around and wait?
Yeah, absolutely not. We don't just sit on our hands and wait for the next quarter. We reevaluate in that moment, and we make changes to take advantage of it.
So as far as the way that people benefit directly from this, we talked about this some as far as what we're doing on their behalf. And we already provided the recommendation that perhaps it doesn't make sense to run out and pick up some more coins at Costco. But what else should people be doing in light of the information that we've shared? How should the individual investor be thinking about this?
Well, there's a lot of questions around the dollar, and a main theme that has been abundantly true over the last 3 years, even with all of the growth we've seen in the stock market, is savings accounts are higher than they've ever been. And money market was paying you a lot starting in 2023 leading up to the beginning of last year. But interest rates in your savings accounts and your money market funds are starting to go down, and they're getting dangerously close to the rate of inflation. So what we're having folks do is reevaluate the money that you're keeping idle, keeping on the sidelines, because it might be time to invest it and make sure it's going to work for you.
No, that's such a good point. I remember a couple of years ago when the interest rates were so high, some of the conversations that we would have with clients, and even folks that would talk in terms of, well, at 5%, then, and they would start building out projections of what their cash was going to do. That's only true if you can get the bank to guarantee that they'll stay at that 5%, but they don't. And inevitably that's going to decline, and it's got to be time to reevaluate that, to figure out what the right amount of cash is to maintain, and that's certainly a great time to have that conversation.
Yeah, and I know it's different from person to person, and typically people recommend somewhere between 6 to 8 months worth of expenses sitting ready to go, ready to deploy in case of an emergency. But if you're sitting above that, especially significantly, and granted, there's a personal touch here. I don't know if you want to add any thoughts on how much is the right amount to keep in that savings account. But once you figure out what that right amount is, you got to invest the rest. You have to have a systematic way of keeping that up.
Certainly, the cash reserves are a crucial factor there. So much of it, though, is emotional, right? The math, like you said, works out. The recommendations typically 3 to 6 months. If you're in a more volatile industry, maybe 12 plus months. But even there, you want that layered, right? You don't want it all sitting liquid. And so having that understanding and identifying what really needs to be liquid versus what needs to be invested is essential because of inflation, because of having that purchasing power erode over time. And so those are conversations we want to have with folks, for sure. Would love to open it up and see what questions might have rolled in at this point. We've got just a few minutes left in the broadcast. I appreciate you all taking some time to jump in and join us. We can always count on folks like Jeremy to ask us whether we'd rather fight a single horse-sized duck or 100 duck-sized horses.
What would you pick?
So in that particular case, I think I'd rather not have to fight a gorilla, because I'd need at least 99 additional men to do so. But I'm going to have to go with the one horse-sized duck. I feel pretty confident that I could outflank him. Whereas all of the tiny horses running around would be a problem for me. So that's the direction I'm going to go. How about for yourself?
I'm still just trying to get over the imagery of it. But I don't know. I'm a tall guy. I just start kicking. Give me a 100 of the little ones.
All right. There we go. There we go. So we have perhaps a slightly more serious question that rolled in, though. So Kelly wanted to know what effect the crackdown on Russia's ghost fleet might have on the U.S. in general, and in particular on cost of fuel. So to catch everybody up there, this is not a fleet of ghosts per se, similar to our horse-sized duck and duck-sized horse conundrum. This is in fact tankers. So these are ships that are transporting oil all over the world, and particularly as a part of taking over Venezuela, we've been begun to really get involved in interrupting those supply lines. And so much of the activity around the dollar supremacy and the price of oil, thus energy, comes down to the movement of that, and the movement particularly of oil in and out of Venezuela. We have had a suspicion and now had confirmed that there are giant tankers that are running and smuggling that illegally. And so the U.S. government has begun to get involved in that. As that supply gets interrupted, the question is, what is the impact, if any, to the cost of fuel and then ultimately to energy as a whole?
Yeah, I mean, supply-demand curve, that'll answer the question immediately, because if the U.S. is cracking down on something that uses energy, demand goes down, therefore price goes down. As it's just a easy math equation there. But how big of an impact? It's really hard to measure.
Well, the thing that I think is going to mask it ultimately is the fact that overall the price of oil is on the decline, and it has been for a couple of years. So anyone who has been watching Landman is probably going to jump in and say, oh, I'm pretty sure oil's around $70 or $80 a barrel. That was true in season 1 and season 2. But that was also true at the time when those were being filmed. The reality is that partly because of supply, to your point, that's been continuing to ramp up, but also just because of the reduction in demand at the same time, we've actually seen the price decline pretty notably. So the price of oil is down in the neighborhood of $50, $60 a barrel, depending on when you look and whether you're looking at Brent versus WTI, and it's projected to continue to decline in the near future. And so any impact to the cost is probably going to be more so masked by those larger macro effects that are going on.
Absolutely. And that's how we keep our strategy, is at the macro level. Just, I feel like in closing, it would just be good to remind everyone we're not stock pickers. We look at these macro trends. We analyze what's going on in the broader economy as we make our investment decisions. And the themes that you've likely heard today are going to be all surrounded about AI, and then, the sectors that are affected by it being materials, being energy, especially nuclear. And then you've got, the running fear of the dollar, and how are we protecting ourselves against it? High dividend paying stocks.
Well said, and I want to thank everyone for taking some time to join us today. I want to thank the team for putting on a great production.
Holy, yeah.
And I want to thank clients for their continued trust in our team and our ability to help you navigate all of the ups and downs of the market, all of the ups and downs in your lives, and being one piece of what ultimately is the stewarding of your legacy. Thanks so much and have a blessed day.